All right, today we're going to try and solve a financial puzzle. We're digging into a company called ScanSource. Now, at first glance, it seems pretty straightforward, but when you look at the numbers, well, they tell a really strange and contradictory story. So let's get into it. Let's start with just one number, $40.43. That's what one share of ScanSource stock was worth at a recent market close. Simple enough, right? But this one little number is actually the first clue in a much bigger mystery. Because here's where things get really interesting. Some ways of looking at this company suggest that price, the $40 everyone agrees on, is totally, completely wrong, and not just by a little bit. So there's a tool called a discounted cash flow analysis. It's basically a way to estimate a company's true intrinsic value based on all the money it's expected to make in the future. And that model spits out a number for ScanSource that is, well, it's just wild, almost $145 a share. I mean, that is a gigantic gap, more than 3 times what it's actually trading for. Okay, so what is going on here? How can the market price be $40 when a serious financial model says it should be over $140? That's the mystery we are going to try and unravel today. To figure this out, we're basically going to become financial detectives. We're going to look at the clues that support the bulls, the people who think this stock is a total steal. And then we'll look at the clues that support the bears, the ones who think there's big trouble on the horizon. First up, let's hear from the bulls. What evidence are they seeing that makes them think ScanSource is a hidden gem just waiting to be discovered? So our first piece of evidence is something called the P/E ratio. The easiest way to think about it is like a price tag for profits. It tells you how much you're paying for every single dollar the company earns. Usually, a lower PE means you're getting a better deal. And this is where the bull case really starts to shine. ScanSource's forward PE, that's based on what analysts expect it to earn, is just 8.62. Now compare that to its own average over the last 3 years, which was over 12.5. This means the stock is trading at a huge discount to its own recent history. For a bull, that's like a big flashing buy sign. Okay, next clue. Let's check on the company's overall financial health. A great tool for this is the debt-to-equity ratio. It's kind of like looking at your own finances, how much debt you have versus how much you're actually worth. You obviously want to see way more assets than debt. And wow, on this front, ScanSource looks incredibly healthy. Its debt-to-equity ratio is a tiny 0.11. I mean, that puts it in the top 10% of its entire industry for being financially solid. And not only that, they're actively paying down the small amount of debt they do have. It's down over 26% just this past year. On top of all that, you've got 3 out of 4 professional analysts who cover the stock calling it a buy or a strong buy. The case for the bulls is looking pretty airtight, right? So if we just stopped our investigation right here, the answer would seem obvious. We've got a rock-solid company that looks super cheap. Case closed. But, it's never quite that simple. All right, let's flip the script. Now we need to hear the other side of the story. It's time to look at the evidence the bears are seeing, the clues that suggest there are some serious cracks in this company's foundation. The first piece of evidence from the bears is a metric called return on invested capital, or ROIC. Basically, it answers a simple question. How good is this company at turning $1 into more dollars? It's all about efficiency. Higher is better, and a low number, well, that's a red flag. And here's where we find a big problem for the bulls. ScanSource's ROIC is only 6.9%. That's not just low, it puts them in the bottom quarter of their entire industry. So even though they don't have a lot of debt, they're just not very good at making a profit with the money they have compared to their competitors. But this next clue, this one is probably what's keeping the bears up at night. Take a look at the company's free cash flow growth. For the last 3 years, they were on a tear, growing at an average of over 42%. Amazing, right? But in the last 12 months, it has absolutely fallen off a cliff, down more than 51%. That's not just a slowdown, folks. That's a 5-alarm fire. It suggests something is going very wrong with the business right now. So what do we do with this? We've got 2 completely opposite stories. On one side, it's a cheap, stable company. On the other, profitability is weak, and its cash flow has just imploded. Untangling these conflicting signals is the key to solving the mystery. This table really lays out the whole problem. Just look at the TTM column. That's the last 12 months. Net income growth looks great, up over 17%. But then slide over to the 3-year average for that same metric, and it's negative. The difference for free cash flow is even crazier. You see that incredible 42% growth over 3 years sitting right next to a total collapse of negative 51% in the most recent year. You literally get a different story depending on which column you look at. And that right there is it. That's the heart of the debate. It's not that one side is right and the other is wrong. The numbers themselves are telling two completely different tales at the exact same time. This is why some people see a $140 stock while the market is only willing to pay $40. So, where does all of this leave us? We've played detective, we've looked at the clues from both sides. Now let's just lay out the two competing narratives nice and clear. Okay, so here's the whole ScanSource mystery in a nutshell. The bull case. You've got a financially healthy company with almost no debt, and it's trading at a price that looks really cheap. The bear case, its profitability is weak, and its recent performance, especially that cash flow, has fallen off a cliff, suggesting the business is facing some serious problems. And this is the classic investor's dilemma, isn't it? You have this showdown between value and performance. So do you bet on the strong financials and the cheap price, hoping that this recent downturn is just a temporary blip? Or do you look at that scary performance drop and think, no way, this cheap price is a trap? The data gives us all the clues, but it doesn't give us the final answer. So the real question is, after seeing all the evidence, which story do you believe?